Section 4 of Topic 6, Paper 7 covers financial risk management in Hong Kong. Now, the Hong Kong government is keen that the financial markets in Hong Kong adopt appropriate financial risk management systems, processes, techniques to ensure Hong Kong is right up there with world best practice. So let's look at financial risk management systems and processes. And we're going to consider the regulatory structure with regard to authorized institutions, AI. Now, authorized institution is authorized by the Hong Kong Monetary Authority. That is the term used in the banking ordinance, and it's principally banks. You may have come across authorized financial institution, AFIs, and that's the same concept, but that's the term used in the Securities and Futures Ordinance. So authorized institution, authorized financial institution, they are the same thing. So we'll be looking at the regulations for AIs, and then we'll look at fund managers or licensed corporations, and then corporations generally. Now, with regard to the authorized institutions, the role of the Hong Kong Monetary Authority and Basel Committee's guidelines are considered. Now, HKMA oversees the conduct practices of all authorized institutions, and in doing so, it's adopted the guidelines recommended by the Basel Committee. Now, the Basel Committee can be referred to in the exam. It was set up in 1974 to improve control measures of banks, obviously worldwide, enhance the global banking environment. Now, the core principles of effective banking supervision, as held up by the Basel Committee, specifies 4 elements of a robust risk management system. These 4 elements: active board management supervision, effective organizational policies, procedures, and limits for managing business, adequate risk measurement, monitoring, and management reporting systems, and we've covered some of that in the previous part of Topic 6, and comprehensive internal controls, including internal audit functions. Now, the Basel Committee has issued other guidelines for banking industry over the years, looking at raising capital quality, among other things. Okay, what about the HKMA and its risk-based supervisory approach? Under such an approach, the obligations of the authorized institutions include comprehensive risk management systems, so we're now focusing on Hong Kong, policies, procedures, limits, and controls to manage various risk types, appropriate board committees, including audit and risk management systems, systems and procedures to ensure compliance with the Hong Kong Monetary Authority. So we were looking at the broader picture with regard to the Basel Committee. Now we're looking at the risk-based supervisory approach that has been adopted by Hong Kong Monetary Authority. And at the bottom, it tells us that the HKMA carries out supervision of the banks of the authorized institutions through off-site reviews of statistical returns and accounting reports. And that's desk research, sitting at their desks at the HKMA looking at these reports, but also on-site reviews to inspect processes and systems, and also tripartite meetings between HKMA, the authorized institution, and the authorized institution's external auditors to discuss risks and controls. That last bullet point can give rise to a question, so I'd be aware: off-site reviews, on-site reviews. Continuing with the authorized institutions and the risk management of them, capital adequacy ratios, minimum liquidity requirements, capital adequacy standards require that minimum levels of shareholder equity must be maintained to support a bank's investment and lending activities. Capital adequacy ratios measure banks' capital express a percentage of its risk-weighted credit exposures, and although we haven't listed it there, the recommended level by the Basel Committee is 10%. So be aware, 10% is the capital adequacy measure. And the Basel Committee recommends that financial institutions use VAR, value at risk models, to set appropriate capital levels. Okay, moving away from authorized institutions, now we look at licensed corporations, which fund managers are part. And we're told that the Securities and Futures Commission oversees the risk management systems, processes and techniques adopted by Hong Kong's licensed corporations and regulates the way in which retail funds are marketed to the public. So that is an element of risk management for the funds going into Hong Kong. And then corporations in general, we have the corporate governance, and that is encapsulated in the Companies Ordinance in Hong Kong. Corporate governance refers to the process by which directors supervise and control the management of companies on behalf of shareholders. And the corporate governance processes should manage financial risk, and they should include controlling credit exposures, controlling investments, and written policies and procedures. Okay, so there is a number of risk management approaches, procedures with regard to authorized institutions, the licensed corporations, and corporations in general. Moving on to payment systems, this is the interbank payment systems, and they are considered an important aspect of risk management. We have delivery versus payment, and that means that transactions are only settled when funds are available, which seems sensible, thereby mitigating settlement risk. And we've had the real-time gross settlement system. Now, we've seen this pop up in topic 2, and it appears again in topic 6. And that ensures, it's run by the HKMA, ensures all gross positions of banks are settled on a continuous deal-by-deal basis. So a bit of repetition here, but be aware of that point because it just heightens the probability of being examined. Continuous deal-by-deal basis, not at the end of each day, etc., etc. Credit ratings as part of risk management with regard to debt. We have the credit rating agencies, and they assign credit ratings to debt issuers on their ability to repay debts. Remember, that's a major point. And with debt issues on the increase, investors increasingly look at published credit rating agency ratings to help with investment decisions. And credit ratings were a big issue in the subprime crisis of 2007, 2008, where the rating models were found to be deficient. There was conflicts of interest, and so that has been tightened up. Now, top of page 10 as part of risk management, novation. Now, novation is the process by which securities exchanges minimize credit risk. Well, it goes beyond that. Credit risk is eliminated on the exchanges, and that is achieved by the clearinghouse taking the role of central clearing counterparty as buyer or seller to each purchase-sale transaction. So you have a clearing participant for the buyer, a clearing participant for the seller, and a clearing house. The clearing house will buy from the seller and sell to the buyer and will guarantee settlement. That is the process of novation. And it does not fail because the last bullet point under 4.1.4, it's backed by a compensation fund made of brokers' contributions, a bank guarantee, and finally an insurance policy. So if it all went upside down, the clearinghouse could claim on the insurance policy to settle the trades. Different financial risk management techniques are covered in section 4.2. The use of derivatives, exposure netting, that's used by global corporations and fund managers involving setting off gains of one asset against losses in the other. Documentation, global master agreements covering OTC derivative transactions is an example. Securities margin financing, I wouldn't call that a risk management technique, but it is the collection of collateral and marking to market on a daily basis, which avoids settlement risk. Mark to market is where book collateral value is adjusted to reflect its current market value, and we considered that just in the process of security margin financing. The role of market makers provides liquidity in the market. We're told minimizing traded market risk. And limit setting, well, that's just setting limits with regard to market and credit risks. Okay, well, the last section, section 4.3, considers lessons from the past. And here the material highlights some major corporate collapses in the recent past and the lessons that can be learned. Now we start bottom of page 10 with the Barings case. This was the world of Nick Leeson in 1995, where he conducted back office, front office, all office procedures with regard to futures trading for the Barings Bank in Singapore, and it all went horribly wrong. He had to disappear. He was then caught and put into prison for the case. But what came out of it was the ignorance of the senior management. So the point that's made right at the bottom, management of the bank were shown to have little understanding of futures trading and failed to question the extraordinary Singapore profits. And that highlighted the problem of management, senior management, not understanding the business. And you require that to be able to identify risks. So that was the learning point in the Barings case, that senior management should understand the business to be able to then measure, manage and monitor risks. The Enron case is in 2001. That's where a major US energy trading company collapsed. One of the main problems there was the questionable auditing practices of Arthur Andersen. And Arthur Andersen was part of the big five firms in those days. Well, it dissolved and it became the big four. The Enron case highlights the need for good corporate governance on the part of company boards who should set business cultures of transparency, accountability, high quality, accurate information for shareholders, avoidance of conflict of interest among employees, directors, and auditors. The number of problems there. One was the share option schemes for senior management, encouraging them to report continually increasing earnings, where the earnings, as we discovered, were fabricated. Avoidance of conflict, we've covered that. And investment portfolio diversification. Problem with the Enron case is many of the employees had their pensions entirely in stock of Enron, and Enron collapsed. And so with it, their pension schemes collapsed. And so that was a real clarion call to diversification in pension funds. The Metall Gesell Shaft case, we'll call that MG for short, involved major German industrial conglomerate where they hedged the risk of rising oil prices with 1 month future contracts on the New York Mercantile Exchange when their delivery was over a 10-year period. Second last bullet point there, in December 93, market rumours emerged of cash problems at MG. The exchange demanded higher cash deposits to keep the futures positions open, and counterparty derivative dealers demanded additional collateral. And by late December 93, the management took control, liquidated all futures position, incurred loss of $1.33 billion US dollars. So what are the learning points for the MG case? At the top of page 12, don't hedge long-term risks. That was over 10 years with short-term instruments, 1 month, because you come across liquidity issues. Top management needs to understand how futures hedging operates. Again, management must understand their business. Cash requirements for hedging must be quantified, and changes in cost of carry relationships, that's the cost of the underlying asset, can inflict losses when short-term futures contracts are rolled over. 4.3.4, Lehman's Brother case, well, that's in 2008, where they had a mismatch between liabilities and assets, and they went bust. Third bullet point, as with other major investment banks, its assets were largely long-term, liabilities largely short-term. So when the US housing bubble burst in 2007, mass mortgage defaults in 2008, Lehman reports second quarter loss of $2.8 billion. Now, to sustain its position, Lehman required substantial short-term financing, and it was not forthcoming, and that led to bankruptcy. And Lehman's demise came from a combination of business factors. However, as it says, central to its spectacular fall was poor liquidity management and the perils of extreme leveraging. So they had high levels of debt. 4.3.5, the Madoff case. Bernard Madoff ran the largest Ponzi scheme in US history, where he was taking money, billions of dollars from thousands of investors, and instead of investing it, he was using to pay subsequent investors coming into his scheme as if they were in fact getting returns. He was credible because he was chairman of NASDAQ. And although the fund produced a return of 10 to 20%, it was just all fabricated. It did not make any trade transactions. The fund, as it says, third last bullet point there, the fund reported 64.8 billion in client assets at the last statement. But by the end of 2017, 37,011 victims of the scheme received a total of 2.7 billion from the liquidation. So they reported 64.8, and when liquidated, it was 2.7 billion. Madoff himself sentenced to 150 years in prison, forced to pay back 170 billion US dollars. I would imagine that was difficult to liquidate. But the major point highlighted by the Madoff case is audit issues with investment funds, because the audit was obviously not appropriate. Nobody was alerted to the problems, and the shareholders should have, and indeed investors, should have been warned, should have been informed of the perilous case that the fund was in way before the problems arose. And lastly, 4.3.6, government initiatives. In Hong Kong, government has initiated several initiatives over years to promote best practice in the financial risk management. And central to these are the Hong Kong Monetary Authority and the Securities and Futures Commission, two regulators that you will have studied a fair bit about in the SFC exams. That brings us to the end of topic 6 on financial risk management, and you will have a number of questions in the exam on those. The calculation questions are not too daunting as long as you understand the underlying principles. And as ever, to bring your short-term memory up to speed in preparation for the exam, there is no substitute for practice exam questions, and those can be found for paper 7, over 300 of them, on Examinator.online.